Most people don't realize the scale of traditional finance infrastructure. Payroll goes through ACH, the automated clearinghouse. That's about $87 trillion a year, and who dominates ACH? JP Morgan and Wells Fargo. Between the two, they clear more than half the volume, and they charge 100 markups on what it costs them to process. That's the business. The total market cap of all stablecoins today is about $200 billion. So when Citi put out a note projecting that this will grow to $3.7 trillion by 2030, people called it bullish. I called it laughably conservative. Why? Because compared to traditional rails like Fedwire or ACH, $3.7 trillion is a rounding error. If we're talking about truly transforming finance, we're aiming far beyond that. The vast majority of payments today are entirely bank-controlled. Fedwire, ACH, SWIFT. You don't touch these unless you are a regulated bank with direct access. No fintech has that. So for every payroll direct deposit, every corporate treasury transfer, every syndicated loan disbursement, you're going through legacy rails that are centralized, closed, and expensive. And guess who profits from that friction? The top banks, especially the ones that dominate clearing, like JP Morgan. But now something is shifting. Suddenly, JP Morgan is talking about embracing blockchain, issuing their own stablecoin, doing cross-border settlement experiments, because they see what's coming. They're not embracing it out of idealism. They're doing it to stay in control as the rails change. The demand for real-time, programmable global payments is exploding. Whether it's cross-border payroll, supply chain finance, or retail remittances, users want money to move like data does. Instantly, 24/7, no intermediaries, and with built-in logic. Stablecoins are the only viable on-chain asset that combines price stability, programmability, and global liquidity. Now layer in cross-border. That market is already $260 trillion and deeply inefficient. Most remittances and trade finance still involve multiple correspondent banks, fees on both sides, and days of delay. If you can solve this with programmable, dollar-backed tokens that settle in seconds, that's not $3.7 trillion. That's a multi-quadrillion opportunity. We're not just talking about moving money faster, we're talking about rewiring the financial system so that stablecoins aren't a new asset class, but the default settlement layer for all kinds of value exchange. Payroll, stablecoin B2B payments, stablecoin trade finance, stablecoin cross-border treasury flows, stablecoin. And not just dollar-backed. We're going to see programmable central bank currencies, tokenized treasuries, yield-bearing stablecoins, multi-chain settlement, all interoperable. When I see a $3.7 trillion forecast, I say, you're not thinking big enough. You're still comparing this to crypto markets. You should be comparing this to the financial plumbing of the world. Because the real disruption isn't Bitcoin. It's not even Ethereum. It's the idea that money itself, the most fundamental layer of trust in our economy, can now move without banks, without borders, and without permission. And once that happens at scale, it doesn't just change payments, it changes everything.
The vast majority of corporate payments go through Fedwire. Your payroll will typically go through ACH. That's 100% banks. There are no fintechs that have access to that. Right. When Citi put out an optimistic forecast that stablecoins, which are about 200 billion now, will be at 3.7 trillion by 2030. I said that's laughably low. Fedwire right now is processing $1.1 quadrillion in payments, so 3.7 trillion is nothing compared to that. ACH is about 87 trillion, and the biggest ACH providers are JP Morgan and Wells Fargo. They clear more than half. They have more than a 100 times markup on those. Okay, so no wonder why JP Morgan is suddenly flipping and embracing it. And then the cross-border piece is also huge. I think it's around 260 trillion. 3.7 trillion is a drop in the bucket. We're going to be way above that, I think.
There's a coordinated push happening right now, inside government, inside agencies, and across the financial ecosystem, to wrap up crypto regulation by August. That's not speculation. That's not rumors. That's being widely reported across industry media and confirmed by multiple insiders. And it's not just about stablecoins or spot ETFs anymore. This is about a complete market framework. We're talking about listing standards, exchange rules, and token classification. The goal? A clear, functional system that defines which digital assets can enter the public markets, especially ETFs. The SEC has been working since January on a crypto asset framework for public exchanges. What does that mean? A generic listing standard, think of it like a filter, that determines which tokens qualify to be included in ETFs or other registered products. This is massive. Why? Because until now, the SEC has treated the entire industry like a gray area, or worse, a minefield. But this signals something different. They're not just saying no anymore, they're trying to define how to say yes. That's a shift. That's regulatory progress, and it's happening fast. If you're an asset manager, you don't just want to list Bitcoin or Ethereum anymore. You want diversified products, crypto baskets, layer 1 indexes, DeFi exposure, even tokenized commodities. But you can't do that until someone defines which tokens are securities and which are not. This is what that framework is meant to solve. And once that's in place, we're talking about a Cambrian explosion of ETF innovation. You'll see Solana ETFs, Chainlink ETFs, DeFi protocol baskets, and the floodgates of institutional capital finally open. This is why the timeline matters. If the administration is serious about wrapping this by August, then this summer is pivotal. Crypto has become a bipartisan issue, with lawmakers realizing that being anti-innovation is a losing position. And with an election coming up, no one wants to be the party that blocked financial modernization. But it's also market-driven. The success of the Bitcoin spot ETFs, record inflows, record adoption, proved that the demand is real, and it gave regulators something they've been missing for years, a controlled experiment that worked. To build a system where multiple assets can be offered safely, transparently, and within existing structures. That's why this framework matters, because without it, crypto remains off limits to most of the capital in the world. This isn't about picking winners or losers. This is about finally having rules. If you're a token issuer, you'll know what it takes to be listed. If you're a fund manager, you'll know what's allowed in your ETF. If you're a developer, you'll know the compliance boundaries. That clarity unlocks everything: institutional adoption, product innovation, cross-border participation, even the rebirth of US crypto exchanges with global competitiveness. It's not just about regulation, it's about normalization. Bringing crypto into the same regulatory light as equities, bonds, and commodities. And once that happens, crypto stops being a niche asset class and becomes a core building block of modern finance. There is a regulatory countdown happening, and the next 6 to 8 weeks are absolutely crucial. If this framework lands, and it looks like it will, the floodgates open. Don't sit on the sidelines.
I don't think it's too much of a coincidence. There really is a push by the current administration to get all of this wrapped up by August. Mm-hmm. And in addition to what you're seeing right there, there's also and this has been widely reported. I'm not sharing anything that's secret.
Right.
But now it's being widely reported that there's a framework coming out for crypto within exchanges, public exchanges, meaning a generic listing standard that the SEC has been working on for the last, since January, that will decide which cryptocurrencies can go into an ETF or not. So that's, again, been widely reported, and I'm sure that that's being worked on this week as well. So you also have that. So there is a lot happening right now. So we're very excited about the progress here.
While everyone's watching Bitcoin grind higher, and yes, I do think it's on a path to around 140K, the real signal is happening underneath the surface, specifically on Ethereum. Now you might think, wait, isn't ETH kind of boring right now? Low yields, low volatility? Sure, but when you dig into the staking layer, the picture gets a lot more interesting. Valor yields are at all-time lows, which usually signals overcrowding. But despite that, the staking queue is at an all-time high. Total number of staked ETH is also at record highs. The number of wallets staking for the first time, also climbing. It tells us the long-term conviction in Ethereum is extremely strong. People are willing to accept near-zero yield just to be in the game because they don't plan to touch that ETH for months, maybe years. And when you have high staking participation, it means less ETH is liquid, less is available to trade, and that creates tight flow conditions. When supply is locked, not just staked, but locked psychologically and economically, price tends to drift up over time. We've seen this play out before. In past cycles, when long-term staking or locking behavior spikes, altcoins follow, because locked tokens mean lower sell pressure. And that opens the door for a rotation into higher beta assets, i.e. altcoins. So while Ethereum itself might not be ripping, it's quietly creating the perfect setup for an altcoin rally. Some will lag, some will lead, and some will just fade into irrelevance. And here's where I get a bit more selective. Take Solana, for example. Nothing against it, there's plenty of interest. Developer activity is strong, but let's be real, it hasn't hit a new all-time high in over 4 years. That tells me something. It tells me that Solana's upside this cycle may be capped, not because it's broken, but because the market wants something new. Fresh narratives, new technology, untapped upside. Newer protocols that are combining technical innovation with growing community traction.
Mainly having to do with things like, looking at Ethereum, for instance, the yields on Ethereum is at all-time lows, but the queue to get into validators is at an all-time high. The number of tokens on validators is at an all-time high. People that are staking is at an all-time high. So usually when you have a lot of long-term staking activity across protocols like that, then altcoins rally because you can't move it around, you can't trade it. So there's really only one direction that up. I'm a little bit more neutral. I'm in the camp of Bitcoin will continue to rally up to about probably 140, and altcoins will follow it. Some will outperform, some won't. There will probably, like Solana's one where there's a lot of, I've got nothing against Solana, but there's a lot of interest, but I don't believe it'll hit a new all-time high this year. I don't believe Ethereum will hit a new all-time high this year. I mean, it hasn't hit an all-time high in 4 years. It's going to be the newer tokens like, things like SWI and Injective, Axelar. Those are the ones that I expect to hit all-time highs. The newer technology that are building really interesting things. Say is another good one. Those protocols will compete and likely hit new all-time highs where some of the bigger ones won't.
A few standouts. CU Alsaz, exceptional performance layer, building aggressively. Injective, INJ, gaining traction in DeFi with unique infrastructure. Alzalar, making real strides in cross-chain interoperability. SiZe, targeting high-frequency DeFi and trading apps. These aren't just speculative moonshots. They have real tech, active development, and growing ecosystems. And they're still early enough to see exponential upside if this rotation plays out. And here's the key. Many of these are closer to all-time highs already. Momentum plus innovation equals a powerful combo. Focus on protocols with SEAL usage metrics, sustainable tokenomics, activity and community growth, momentum, both price and attention. Because as we move into late Q3 and Q4, there's a real chance that capital flows out of Bitcoin dominance and into altcoins with fundamentals. And those that can't break their old highs, they'll get left behind.